Welcome everybody to our webinar for today. Glad to have you as we take a quick look on a Friday afternoon at some of the FANGR stocks and see if there's anything to do. We'll get your opinions, your wisdom, and we'll look at some strategies. I think I might start with a little look at the SPX and give my 2 cents. It might only be worth 2 cents. It might be worth 1 cent. It might be 3. I don't know. We'll see. So as you look at the market, almost about a 10% correction, right? That culminated around August 30th. And, the VIX for most of the last 3 months has been 22 to 35. And so this kind of correction took us down about 10% off the highs. That's what they, almost 10%. And then kind of rallied a bit, right, into the election and stuff like that. And then the VIX popped almost to 40. And then once the market started going up, VIX came down a bit, but a lot of the volatility was pumped up before the for the election. And so after the election, like an earnings event, the vols come down. So, right now, if this has been the range, other than a little bit of pop here, the VIX is 23 today. So we're on the lower end of the range right now, right? And SPX up 40 points today, VIX down a couple points. And that's where we're at, right? So from a VIX point of view, we're kind of in the lower end of the range right now. Again, we have not been under 22 in the VIX since basically back here. You say, Dan, we're back in the correction about 8 months ago. With all that being said, kind of a range, a little bit low vol, and things are quieting down. Why are things quieting down? The election's over. The event is over, right? Now you still have events, vaccination today, tomorrow problems with vaccination, Monday it'll be vaccination great, Tuesday it'll be, we got problems with vaccination. Next Wednesday it'll be vaccination great. There's, so the bottom line is, would everybody agree? It's a process. This is going to be a process. Be patient. I think will be more of a range, a little bit lower volatility. The range we're looking for, in the market, we've kind of been in a range, I think in about 10 days ago, we got as low as maybe, near 32.80 in September down to 3,200. So, it depends on how wide you want to get that here. But if you go back to even September and stuff, we might be, let me just check that again. September, we got near 3,200. So if you want to make rough, we're 3,200. Highs are 36.45. We're at 35.79. Now that's a little wider. That's taking us the last 2 months. Obviously, we can tighten this range up quite a bit if we narrow the time period. But again, get a little bit of range here after this mammoth move, 300 point up. So, I think we need a little more going down, just natural. Not that I'm bearish or bullish, but it doesn't look like the market wants to go much down, does it right now? Again, I just think this range of 22 to 35, and that's going to drive a lot of our decisions. Now, so I'll stay away. I usually always talk about SPX. Let's look at stocks. There's no earnings till the rest of the year. If we bring up a chart, let's start with Apple. We'll go fishing for trades a little bit. Look for a few things that look interesting. So let's start out. Apple looks, if you look at a chart, this is a year price chart. I'll circle just so we can get a focus. Here's the last month. Then Apple, what would you say if somebody asked you, you went to Starbucks, someone said, how's Apple been behaving the last month? What would you say to them? So the last month we've been 108 to 125, and we're at 118, kind of in the middle of the range relatively. Yeah, it's been channeling, right? Consolidating. So with that being said, right, and so it's going to be kind of range bound. The implied volatility has been going down, so we have lower so we have maybe lower volatility, range bound. So would it be fair to say most of you the next 2 weeks, would it be fair to say most of you are not too bullish or too bearish, right? If that's the opinion, okay, so let's take a look. A little bit lower vol. You can see if this is a year range in terms of the volatility levels, not at the absolute low, but we're kind of in the lower levels. So I'm going to look for a range-bound trade, maybe long volatility trade, and let's just see what we can do. Here's a Nov 27, right, going into the Thanksgiving. Let's look at a few things. So maybe you start out with a calendar. And let's just see how that looks. So I'm going to sell maybe at the money. Let's see, Apple's at 118.48. They don't really have a 118.50 as much. So either 118 or 119. Let's say I go 119. All right, give it the benefit of the doubt. And if I sell the Nov 27 14 days out, and if I bought the December 4, right, 7 days past it, or I can buy the December 11. What if I buy the December 11? Something like this, right? So I'm buying one December 11, 119 call. Again, I'd like to go at the money, but they didn't have a 118.5, so I had to pick 118 or 119. I chose 119. So sell one Nov 27 about 2 weeks out, 119 call. And that's going for around $1. Let's call it $1.35 debit. So $135 for every one. And you can see the gist of a calendar. So what is a calendar? You're buying a further out expiration, selling a closer in expiration, usually, and it's the same strike. And if you're more neutral on the stock or you think it's range bound, you'll do it close to at the money, which we are here. So you can see here's, profit at expiration. Looks like you make money if it stays near 119. How do you do that? Well, if we closed at 119, this is the expiration graph in Thinkorswim. This is your graph today. And over time, your T plus 0 or graph today will morph into the green graph. But the big question is, how do you make money? On a $135 investment, it says you can make $100. How's that stinking possible? Well, the assumption, all right, is that, okay, I'm buying let's put some prices to this just so it's easier to see things, right? So if we're buying the DEES 11 119 call, and that's going for around, your long is going for $3.80, or let's call it $3.90. And your short is going for $290, $260, $255. So let's go back to our story. Dan, how could I make $100 on a $135 investment if we closed at 119 in 2 weeks? Here's the answer. I'm selling my short option that decays in 2 weeks for $255. I'm buying my December 11 2 weeks further out for $390. My net debit is 135. So let's go over this together as a group. If we close at 119 in 2 weeks at the expiration of my shorts, what is, I sold the Nov 27s for 255. If we close at 119 in 2 weeks, what will that go for? And Petru, I chose Apple because it's, the webinar today is Dan goes fishing in the FANG stocks. So I'm fishing. And as I'm fishing, I see range bound and low vol, threw me over the calendars. All right, everybody put your thinking cap on. We're at 119, November 27th. At the end of the day, what's the 119 calls I sold for 255? What are they going to go for? 0. So you just made $255. Dan, how did I make $255? I sold them at 255 and they close exactly at the strike. Boom, you made 255. What are these worth? Right? What are those going to be worth? Right? Now, here's a good hint, just a rough tumble way to do it. If these are 4 weeks out and these are 2 weeks out, would it be fair to say this should be around this price in 2 weeks? Yes or no? Yes or no? My long is 4 weeks, my short is 2. So we were already determined if we close at 119, our short will go from 255 to 0. So in 2 weeks, our 390 should go down to about, let's just go for math purposes, 250, right? So we paid $1.35. If my long will be 250, my short is 0. If we close right at the short strike, this spread that I paid $1.35 for balloons to 250. And if I sell it, I buy it at 135, sell it at 250, right? That's where this money comes in, and I make $115, 100 and some percent. And I run to all my neighbors and say, in your face, I killed it on a calendar, right? And they don't know what you're talking about. But the point is, are we going to trade for that? Are we going to trade to hit the bullseye and bet that Apple's going to close at 119 in 2 weeks? Is that a good bet? Right? It's like going in an Irish saloon and playing darts, which I've done a few times in my life. And am I going to hit the bullseye? No. So we're not going to hit the bullseye. So what we're saying is it's acceptable to go for less than 100% in 2 weeks. And I say that tongue in cheek. Yes. So if I'm buying this for, let's say $1.35, and again, if I'm trading at TD Ameritrade, is there any commissions? If I'm buying and selling Apple, is there any commissions in Apple? Is there, what did he charge in Apple? Let me see. I'll tell you. So if I go, let's say I go to buy one of these spreads. Let me put in a lower price. I go to buy one, confirm. It says they're going to charge me. Can you see this? I'd pay. They're saying what would be the cost of the debit. Let me see, 129 minus, so $1.30. So they're charging me, even though don't you love it? Even though we're in a zero commission trade, right? Zero commissions. You look at all the commercials, zero commissions. Whatever you want to call this, right? It's like Gary comes to my restaurant, Gary and Bob and Seth and Jay come to my restaurant and I say, hey, food's free today. Dan, you are so nice, free food. Come in at the end of the dinner, I say, hey, yeah, the food's free, but we're going to have a tip, or we'll call it a love tip for $100, 5 cents a commission. I don't know what they call it. they call it commissions? But, but let's put in reality. If anybody's been trading options over 20 years, should any of us feel comfortable griping about 65 cents a contract? Yes or no? No. If that's, let me tell you this, and let me say it in English, Spanish, and a little Norwegian today. If any of you are complaining about 65 cents a contract, that's the least of your problems, right? You need to focus on, how do I make money, right? Right? That should be your focus. How can I make money? Do I have a plan? What am I doing from week to week? Do I understand how to manage risk management? Right? So back to my Apple. So what am I looking to do here? Right? So when you look at Apple, you think, do I have any probabilities in the favor? Now, first of all, and I guess I thought I'd look at more stuff, but I'm just today I've decided I'm just looking at this Apple, trying to spend more time teaching here and looking at this versus whipping around. But I didn't plan on it, but I thought it'd be good to explain a few things. But if you look at a calendar, what's my edge? What do you think your edge is, right? If Carrie or Ken goes to Starbucks and they start talking to people behind the counter, and they say, what's your edge if you do calendars? What's your edge? Well, yeah, it's time decay, but if you look at a price move, okay, your break-even points here are, 123 and 115, right? So I've got $4 up and down over the next 2 weeks is my break-evens, right? $4 up and down over the next 2 weeks are my break-evens. Do you guys see that? So the question is having $4 these break-evens, then my question would be, well, what's the probabilities we're going to go beyond these break-evens in 2 weeks? Because we want this to stay in this kind of range here, right? So if you look at the expected move, you look at this expected move and you say to yourself, wait a second. The expected move over 2 weeks, which is our shorts, is $6. Did you ever hear that expression? Houston, we got a problem. Anybody ever hear that? Houston, we got a problem. All right, so you say, Dan, I'm losing you. What's the problem? The problem is I put on this thing called a calendar, and if I hold it to expiration of the shorts, it's $4 down, $4 up, but the expected move or standard deviation over the next 2 weeks is saying the expected move over 14 days is 6 days, is 6 points. So does that make sense? From a price move, is there edge here? From a price move, do we have edge? No. So what do we got to do here? Well, I checked the U.S. Constitution just before teaching here today. And I read in the U.S. Constitution, page 37, it says, I don't have to stay in this trade till expiration. Wait a second. Are you saying that you can put a calendar on and take it off anytime you want? Yes, this is America, right? So, well, if this is 2 weeks, and I'm trying to pay on this calendar, right? It's going for whatever, $1.35 now. Well, wait a second. What if I only stay in this 2 week trade? Today's Friday. What if I put it on today and I plan to get it off Tuesday or Wednesday and make 10%? Well, wait a second. So Dan, are you telling me that if you're only going to stay in it 7 days, see, this doesn't have like SPX, 9 days, it just has the weeklies, but you can see, even though my goal is to stay in it less than a week, all they have is a week, but you can see now I got a fighting chance. If the expected move over 7 days is a little over $4, you can see where my edge is, right? So my edge is, if I'm going to be in this 1 to 5 days, now it's saying the probabilities of moving beyond these points over 5 days isn't that big. But if I'm going to hold this the whole 2 weeks, yeah, the expected move is out here. Does everybody understand it? So I get the probabilities in my favor. How? Taking a calendar off at maybe 20%, 20 to 25% of the duration. Does that make sense? Yes, no? So I'm only keeping these calendars maybe a quarter of the duration, right? And so, if I take the date today, 11/16, oh no, I was on the wrong date. Go to today. I'm sorry. If I take it today, 11/13, and I go 1 week in the future, the purple graph is the graph today, and I go 11/13 to like next Thursday, you can see this graph is starting to go up, right? And so the idea would be, now it doesn't look as much. I'm going to even make it, I'll just make it so it's a little more dollars. So let's say I did it 10 times. Let's say I did it 10 times for $1.35. So if I do this spread 10 times for $1.35, would everybody agree that's my capital in the trade? Yes or no? If I pay $1.35 times 10 contracts, 135, so I have a $1,350 investment. What would my commissions be on this, right? If I do, now this is where, when you're doing cheap calendars, that's where commission means more, right? If I'm doing a calendar like $12, it doesn't matter. But now you're doing $1.35, so this is where 65 can get a little more expensive. But let's take a look. So we said 65 cents a contract. How many contracts would I have to do on this? If I buy the calendar and then I get out of it, how many contracts is that? 40. Is that right? 10 and 10 is 20. So if I do it, if I buy the calendar, that's 20, right? My long is 10, my short is 10, 10 and 10 is 20. And if I get out of it, I got to do 10 and 10. So it'd be 40 contracts. This gets tougher when you're doing very cheap calendars, but 40 times this would be, my 224, 26, $26. Is that right? 26. So that's my commissions that we have to get through. All right. So if I pay 135 debit, yeah, you may need 10 or 15%. So let's just say 10%. And again, in cheap calendars, commissions are going to eat up more than, I don't run into this problem as much in SPX if the calendars are $12 or something. So if I'm trying to make 10%, 10% off $1,350 would be $135, right? So if I made $135 on $1,350, it'd be 10%, right? Everybody with me? So the problem is, it seems like when you're doing these really cheap calendars, 10% is only taking $1.35 up to $1.48. Do you see that? So when you're doing a cheap calendar like this, you probably got to get more, because if I buy it at $1.35, yeah, and like Petru said, you're going to have bigger percent commissions when you do these cheap calendars. But if I pay $1.35 and I sell it for $1.48, I'm making $13 times 10. So I make $130 less my commissions of $24. So I'm making $104. So instead of making 10% with commissions, it would be $104 divided by 1350. It'd be about almost 8%, right? So yeah, you give up 2%. Now, is 8% in a week chopped liver? Is 8%? No. But you got to be careful on these cheap calendars that there's, take your commission into account. So in this case, it's about 2%. But that's fine. On $1,000 trade, you're making a little over 1,300 trade, you're making a little over 100. You could try to make more. But again, I don't want to be in it till expiration. So does everybody understand the key on there? And these calendars, look at it be in about 25% of the time, right? But again, I'm doing these usually on a regular basis. So, I don't have time to get into adjustments today, but I want to leave you with a plan. So if we're trying to make 10%, I don't want to lose much more than maybe 12%. Over time, when I'm doing these range-bound trades, I'm going to win a lot more than I lose. But the key is, if I lose 12%, I get out. Does that make sense? So you don't have to adjust it and turn it into some. I mean, we do. In the SPX, we do a lot of calendars over the years. And, we'll turn them into double calendars. But, I'm just giving you a simple way here that I would trade it. But again, what's the biggest thing you need for range-bound trades? What's the biggest thing you're looking for range-bound trades? It's a trick question. A range, right? So if I'm going to, I just want to see some type of range. You don't need a range like this. That's in Disney World, right? But we can look at this range. This is not a range, right? But, this is, you got a bit of a range here. And that's the idea. So anyways, that's just that's my 2 cents. I think I'll leave you guys. But that just wanted to cover a little in detail. I thought I'd look at more fangs. Maybe next week I'll go to more fangs and cover more strategies. But I always hate to go over stuff without just to leave you with something without explaining what the heck we're doing. Scott says, what is the advantage, if any, using an individual stock over SPY or SPX? I don't think there's an advantage. I would rather, Scott, we do most of our trading in SPX or SPY or RUT or IWM. I would rather do my income trades in range-bound indexes any day of the week than a stock. You say, why? Because a stock has stock risk. SPX is made up of 500 stocks. Russell's made up of 2,000 stocks. That gives me a warmer blanket in the winter than I'm trading Netflix. One stock. So I'm going to put much capital in that. And something comes out in Netflix and they take the stock down 20%. And I'm like, right? Not that SPX can't go down, but I would rather lay my hat for range-bound income trades, which we do at Sheridan Mentoring, like calendars and butterflies, et cetera, et cetera, et cetera. Folks, I thank you. Thank you for joining us. Check out our site. We have different ways to get involved at Sheridan Mentoring. You could email us. You could email John at Sheridan Mentoring if you want to get involved, maybe try a monthly subscription, just see the types of teaching. But anyways, have a wonderful weekend. If you have any questions for me, Dan at SheridanMentoring.com. Again, always remember, this is a craft. This is a business. This is not a casino, right? We don't, I've been mentoring for 16 or 17 years. We don't get people hanging around for 10, 15 years betting that are still trading based on their ability to pick the direction of the market every week. Good grief, that's tough. We look at probabilities, time decay, and the main thing we teach, besides adjustments and stuff, it's risk management. And that's the only way you're going to be consistent and stay in the business for a long time. So if you're interested in finding out more about what we do, contact us, and have a wonderful day. We'll see you later. Thanks.